Hello, and welcome to the Stockout. This is your show at FreightWaves for all things related to the CPG industry. I'm your host, Mike Bowden-Distel. I'm the head of Intermodal Solutions here at FreightWaves, and this is a show where we set aside 26 minutes to go over what I think is relevant for CPG companies that go to FreightWaves, that subscribe to our data, all of those things, try to highlight the things I think are most relevant for the CPG companies, whether they're just in the news items that our editorial staff is writing, or just data that comes up in our data product. So try to put all those things together in sort of one package that a CPG company can digest pretty easily. Today, I'll talk about the latest inflation data and some good news on food inflation and what those implications are for the CPG industry, which I think on balance is positive, even though food is certainly inflating a lot more than other products. I'll talk about those things. I'll talk about the latest developments in Kroger's bid to acquire Albertsons, the potential for CPG impacts. I know I've talked about that in previous shows. There always seem to be sort of incremental developments there, and I think those developments are going to be with us for the next year plus, depending on how long it takes to get that deal approved. And then I'll give a little bit of a preview of what I'm going to be writing about this week for the Stockout newsletter, which if you are subscribed, you can go to www.freightwaves.com/the Stockout. And this week I'll be talking about Walmart and Target's earnings. And I'll focus specifically on the implications for CPG. I think those things could be interesting. I mean, I think one of the big events so far in the world of freight transportation has been the inventory levels of some of those big retailers. Walmart and Target have come down from where they were, still at a high level, and you've seen it actually higher on Amazon. So I'll talk about the retails, and then I'll talk a little bit about just what's happening in the freight market as far as our data is showing some interesting things there. But first, I'll give a shout out to our sponsor, which today's sponsor is RJW Logistics Group. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full, month after month, to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjwgroup.com to optimize your supply chain today. So big shout out. Thank you to RJW Logistics Group for supporting this content on the CPG industry. I've talked with them a couple times on this show. They have a lot of good ideas for achieving on time and in full compliance with the retailers. And with that, talk about today's first topic, and really the pace of food inflation declines in October, which I think is good news. I mean, you look at overall the CPI still up 7.7%, core CPI up 6.3% year over year. That set off the big stock market rally last week on Thursday, which is the biggest bounce in about 2.5 years. And it was, really sort of an expectation that maybe this means the Fed doesn't have to keep raising interest rates ad infinitum, which would be nice. I would argue that the core number, that 6.3%, is maybe less important than the overall, just because food and energy have been such a big component of people's budgets, and that seems to be supported by surveys. When they have surveys of consumers, like this Nielsen IQ survey, if you take a look at that, and sort of interestingly, the biggest concern that most consumers have is food prices, food inflation up 10.9% year over year in this latest report. Food away from home, or food at home, up 12.4%. Food away from home up 8.6%. So if you're primarily someone who buys groceries, still have a bill that's well into the double digits percentage wise ahead of where it was. Have an interesting chart on retail sales for food and beverage. And so what I'm showing there is in white is basically groceries, sort of food and beverage that you buy at the store. And you see in that white line that big spike up in March of 2020 as everyone stayed home and did all the shopping at Costco, loaded up. And what's interesting is, even though everything's opened up now, we're almost back to where it was, where food and beverage sales are at retail locations, where they were in March of 2020, when that's all people were eating. We're about 3%, within about 3% of March 2020. The blue line on that chart is retail sales at food service locations, so basically restaurants and bars. And you see those, way above where it was, prior to the pandemic levels, actually 28% above February 2020, which I think is a fair comparison because that's sort of right before everything was shut down. So, spending almost as much at food and food location at retail stores on food, just because the prices have been up double digits 2 years in a row for a lot of products, and then at bars and restaurants up almost 30% where they were before the pandemic. So really, food both in the home and outside the home taking a much bigger chunk out of consumers' budgets. I think if there's good news in the latest data for inflation, the month-over-month increase in food was only 0.6% increase. That's actually the smallest in 11 months, sort of from September to October, up 0.6%. But that also drives home that's the smallest increase in 11 months. Sort of every month, the food prices have been higher than the previous month. And so I think that's part of why food prices are on top of consumers' minds, sort of unlike, gasoline, which at least goes up and down. Food prices seemingly only go higher. Hopefully we're getting to an end of that. Of course, a lot of CPG companies specifically, their prices are up more like 15% year over year. That one category, cereal and baked goods, up about 15.9% year over year. It seems to be kind of a social media punching bag right now as the cereal companies for raising prices so much, but really a lot of that, they're not seeing better margins. The margins are still thinner. It's they have costs higher for everything from ingredients to labor to packaging. A lot of those companies' market shares have been going up and down, sort of if they can keep those products on stock. So really a lot of things happening there, with CPG companies. Have another, chart here on comparing the CPI to the PPI. So, and that's one where the consumer price index. Consumer price index. So those are the retail facing prices. So the prices that consumers see, those are in white. And as bad as those have been, as much as those have inflated, you look over the past, let's say 2 years, they haven't gone up as much as the producer price index in green. That's the PPI. So sort of throughout 2021, producer price index has risen faster. That was true through the first half of 2022. So the result is that manufacturers have had thinner margins, and certainly the CPG is one of the industries where that has been true. Most of the CPG companies have thinner margins than they did before the pandemic, and really certainly before they have in 2020, where a lot of them had pretty good years in 2020. But you've had a couple of years where there's been difficulty with margins, and really that's been because the components of the cost of sales to a CPG company would be in ingredients, which makes up maybe 2/3 of it, and then the rest of it would be packaging, labor, manufacturing, and maybe transportation costs. All those things have been rising, and maybe the companies get a break on transportation costs here shortly. But I think a lot of those other components are pretty inflationary still. Maybe we get a break on ingredients with the commodity costs starting to come down. So a lot to watch there. Keep everyone updated on those things, and move on to topic number 2 here, which is Kroger and Albertsons deal to impact CPG tactics. So it's getting to be more clear that the Kroger-Albertsons deal is going to be a political football. I think the consolidation. I think a lot of people look at that and they have this snap judgment that fewer grocery chains means it's going to be higher food prices for consumers. At a time when everyone's concerned about food prices. I'm not sure that's true, because I think really their biggest competition is Walmart, and if they can make that company more streamlined, maybe they can actually compete with Walmart, and maybe it causes the prices to go down maybe in certain locations where they really do compete with Walmart. In other places like a big city, maybe they only compete with other traditional grocery stores. So it could maybe prices differ by region, but a sort of big thing that happened in the last week with Kroger is the court in Washington State, which is Albertsons' hometown, blocked a planned $4 billion special dividend. That would have been $6.85 a share for shareholders, and that's a $4 billion dividend out of $11 billion market cap. So the Washington State prevented Albertsons from putting a lot of cash in the pockets of shareholders. I think part of the reason was they were looking at that and saying, well, this would maybe make the regulatory oversight of the deal less strict, because presumably, I guess the argument goes, you can make the argument that if Albertsons is financially troubled, then you have to allow Kroger to take it over. Otherwise, there's just going to be less grocery competition. I'm not sure that's true. You sort of look at where the leverage ratios were, and it would have gone from like 1 times net debt to EBITDA to 2 times net debt to EBITDA. Still seems like that would have been a reasonable leverage ratio when you compare it to the peer group. So, that's something that it seems like maybe that was a political move in Washington State, but clearly a deal that is going to be closely looked at. Albertsons still thinks, or Kroger thinks, they can complete that deal by divesting anywhere from 100 to 350 Albertsons locations. But I think that's going to be a while before we actually know that. I think it was interesting, some of the discourse around that deal, and one of the things that has been discussed is the enhancements to the data capabilities that Kroger will now have. And Kroger will now have data on about 100 million consumers. So pretty much everyone in the United States who shops at traditional grocery stores. And I think that's valuable to CPG companies. I was talking to a CPG company the other day that is making inroads in a prepared beverage similar to Starbucks Ready Shot, or the Starbucks Double Shot that comes in the can. That was sort of their main competition. And sort of topic came up, could you market it directly to the consumers who buy that competing product, maybe give them 50 cents a can or something really cheap to get them in. This company was really confident in how that product would taste, and so thought that once they get that conquest business, they wouldn't go back to the Starbucks. But if you have that data, exactly who buys those canned coffee beverages, really valuable. And I think a lot of that data is valuable, in other areas as well. I think if you know what a household buys at Kroger, you know a lot about that household. I'd like to talk about how if you know that someone bought baby formula 5 years ago, you can be pretty confident they have a 5-year-old, and they're going to be looking at preschools and doing everything that a 5-year-old parent of a 5-year-old would do. So I think the data thing is interesting. I think a lot of the demographic differences between what you think of as a traditional sort of Kroger customer and Albertsons is maybe more different than you would think. I mean, Kroger, really heavy concentration in the Midwest. Albertsons, heavier concentration in urban parts of the Northeast and the West Coast. They have a lot of them in Seattle, Denver, and in New England. There's some places where there's a lot of there's a lot of overlap, like here in Dallas, but you sort of look at the Albertsons shoppers. I think they're more urban. They're more likely to use public transportation. There's a larger percentage of Hispanic and Asian shoppers at the Albertsons. So I think CPG companies, are going to have to maybe rethink the size of the products that they have at those various locations, and think, well, more people at Albertsons locations now use public transportation. Maybe they're younger. They're going to have different preferences. Maybe they want smaller, package sizes. So potentially, this is a CPG company dealing with a larger, behemoth that's going to be, more than 10% of total grocery sales. But maybe there's also an opportunity to get in front of some new customers if they're stronger with one grocery store and not the other. So a lot to think about with that merger still. And before I move on to talk a little bit about freight, I'll just give another shout out here to RJW Logistics Group. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently delivers over 98% on time and in full to ensure stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com to speak with a retail logistics expert about the advantages of RJW's program and to make the best of your business decisions. So big thanks to RJW Logistics Group, and would encourage you to reach out to them, or also have a couple of episodes on the site where I talked to their CEO, Kevin Williamson, about their capabilities. Actually learned a lot from talking with them. So next topic here is sort of what to watch this week in retailers' earnings. So Walmart reports tomorrow and Tuesday. Target reports the following day, Wednesday. And really sort of the big topic this year has kind of been the retail inventory levels, where go back a couple quarters ago, Walmart's inventory was like 35% higher than the year ago period. Target was 45% higher. Target, launched that big initiative to downsize its retail inventory. And that's been a big thing. I mean, it was interesting now you have Amazon, whose inventory levels are almost 60% above last year, and just saw that the news came out they're going to cut something like 10,000 employees, which remarkably is less than 1% of their total global workforce. And I was like, wow, they really have a million employees. Sort of really cause you to put things in perspective when you think about Amazon having 1 million employees. But I think that's sort of the big thing. I mean, look at for first is maybe inventory levels, and maybe breaking those inventory levels out between general merchandise, which we know is high, and that's where a lot of the discounting has been. Things like apparel, hard lines, furniture, those type of things, electronics. That's where the inventory levels are high. For food items, it's really a different situation where, by and large, there's not too many food items, and a lot of the CPG companies are talking about having their products in stock about 90% of the time, which is really below a targeted level. So it's simultaneously, it seems like inventory levels are too high and too low, depending on which type of products you're talking about. Also, I'm watching closely for any discussion that the retailers have about negotiations with suppliers. You probably saw the big Wall Street Journal article over the weekend where they talked about Walmart getting tough with their vendors if they aren't tough already. With CPG, it's interesting because CPG companies have gone to retailers very frequently over the past 2 years. I mean, really since their costs really started inflating sharply at the beginning of 2021, instead of going to them, let's say, every year, every 6 months, it's been at a much more frequent interval. It seems like now, with commodity prices off their high, the retailers are not going to be so accepting of increases in costs from the vendors. I think the CPG companies are going to have a little bit harder time passing those through. Did like what Nestle said when they reported, and they said that they got their price increases through the retail channel very early. And it seemed like they were anticipating that as soon as commodity prices would start to come down, that the retailers wouldn't accept price increases. I think maybe the relations between CPG companies and retailers gotten to be a little bit more contentious. Retailers doing more things like kind of doing their own investigation of what should the prices actually be in terms of do the commodity costs, packaging costs, transportation costs really support a higher price that's going to be on shelves. And so looking for that, and also looking for any clues that Walmart has to offer the health of the consumer. I think when you look at CPG companies, they're have often talked about low elasticities, or at least elasticities that are less than historical averages. From Walmart's perspective, I mean, I think maybe you could see something maybe a little bit different, because they do have a lot of customers that are middle and lower income customers, and they're going to be more sensitive to things like rising food prices, rising gasoline prices. So that'll be interesting, and I'll write that up for the Stock Out newsletter later in the week. Move on to the next topic here. Often like to talk about one of the articles or one or more of the articles that are on freightwaves.com. And one that caught my eye today was imports from China falling faster than other countries. This was written by Greg Miller, who knows the global shipping industry inside and out. A great way to follow him is a great way to follow this industry. And some interesting stats here. China's share of U.S. containerized imports fell from 41% in February to 35% in October. Still more than a sixth of China's export value comes from U.S. purchases. Imports from China essentially flat from October flat in October from so imports overall basically flat in October from September, but imports from China fell 5.5%. So point is that China's share of U.S. imports is declining, and that's being made up for by a lot of the countries in Southeast Asia, sort of Thailand, Taiwan, in addition to Korea and Japan. And so, would say that this is a part of a longer term trend where China is going to have, represent a little bit lower portion of the volume of U.S. imports. There was a lot of discussion on that on F3, had numerous guest speakers, keynote speakers talking about reshoring. And I do think, reshoring from, Asia to Central America, South America, Mexico, even the U.S. and under automated circumstances, is going to be a big deal. But I think maybe even the bigger trend, or maybe a more impactful trend, is moving that production to Southeast Asia. There was one company that we did a research report, custom research report for here at FreightWaves, and they looked at manufacturing a particular consumer durable product in both China and Vietnam, and their assessment was that the Vietnam quality was higher and more consistent, and but it was more expensive. But they were willing to take that more expensive option in order to have a higher, more consistent product. And the reason why, if you're CPG company, why you should care about this. Let's say you're a CPG company who only manufactures in the U.S., sells in the U.S., doesn't do any importing. It really does have a big impact on U.S. Freight demands and balance of trade flows and those things. So if you think about this from a situation where manufacturing moves from China to Southeast Asia, those containers are much more likely to go through the Suez Canal to the eastern U.S. ports, and that in turn means that there's more demand for to move goods in those geographies, and less demand to move rail intermodal, because those eastern consumption centers are much closer to port locations on the eastern part of the U.S. Containers that go from China through across the Pacific to, let's say, L.A., 65-70% of that goes rail intermodal. If it goes through Suez, which most from Southeast Asia would go through Suez, and some from China also, depending on what part of China it is, that would be more like 20-25% would go rail intermodal. And having more go to the East Coast ports, that would create more balance in the network rather than such a large portion going across the Pacific. And so that can actually lead to greater opportunities for domestic shippers to move goods that are, let's say, manufactured domestically in the Western U.S., to move those to Eastern consumption centers. So, all of these trends, I think, are very relevant to domestic manufacturers as well as importers. So that's something we try to encourage at FreightWaves: is don't just look at the data that's most relevant to you. Look at the other modes and sort of what those say about the mode that you follow most closely. So have a chart here on van outbound tender rejection index in LA. And this is part of the reason why really this is a loose market. So what this shows is that dry van carriers for outbound LA loads only rejecting 2.7% of loads, and normally it would be much higher than that, or at least be increasing this time of year. You see, even in orange, 2019, weak year for freight. There were a lot of carrier bankruptcies that year because the market was so weak. Even then, you saw uptick towards the end of the year. Not sure that's going to happen this year. I think one of the big themes from transportation analyst calls: lack of a peak season, or a muted peak season. Choose your words, but it's going to continue to stay weak. Final topic here is international intermodal volumes. So, very related to that last part. Seems to be declining with imports. I have a chart here on the total outbound international rail container volume, outbound from Los Angeles. And so in white, those are 40-foot containers, primarily 40-foot and 20-foot, that comes off of the port of LA. And you see how those have declined, sort of seemingly right in line with the maritime import shipments clearing customs, which are in blue. There was a disconnect in the late summer, early fall, where you see that the intermodal volume held up better during that period of time than the import shipments. But I think a lot of that was just sort of clearing backlogs, working through the containers that are in queue, sort of waiting to get on a ship. And now those seem to be, both declining. Interesting write-up from my colleague Henry Byers, who said that the Port of Long Beach only one to report in October so far, and their volume was down 23.6% year over year and a 15% month over month decline. So imports are falling into the West Coast, and expect that to be true for most of the ports, maybe with the exception of the Port of Houston, which might be the only one that shows growth in October. Although that's a relatively small port when you talk about the sort of the behemoths like LA, Long Beach, New York, New Jersey, et cetera. So we'll be watching all these trends, and if anyone would like to reach out to me, feel free to do so at mbowdendistel@freightwaves.com, or please sign up for my newsletter at www.freightwaves.com/the stockout. Hope everyone has a great Monday.